In Common Sense today, we are talking active versus passive investing with Craig Bolanos, the co-founder of VestGen, as well as a money manager. Good to have you with us. And sometimes people are passive. They just buy and hold stocks and make very few changes. And sometimes they're very active with investing. What can you tell us?
Well, yeah, these are two schools of thoughts. It's not necessarily a religious debate. It's more of an investment platform. And I believe longer term, most investors are going to be best served by using a combination of passive and active strategies. And if we think about what passive is, since you queued it up, Angela, passive is just owning the market in a tax efficient, dirt cheap, low cost way to participate in what I call great companies of America and around the world. And when you have markets that are highly concentrated in a few names without a lot of VIX, without a lot of volatility, passive seems to win for the day. But I think when we get to a wider dispersion of returns, when we get to opportunity sets in small caps, international, other markets, having an active flair definitely provides alpha, definitely provides value. And that's why this debate isn't as simple as just active versus passive. I think it's both.
What are the benefits of passive investing, just buying stocks and mostly leaving those investments alone?
Well, I mean, the only case you can make for passive investing is number one, someone's going to have reduced tracking error. You're going to get what I call the asymmetrical performance to the upside and the asymmetrical performance to the downside. And passive comes at a lower potential cost. That being said, I think passive can be the core of someone's portfolio, but you need to not just have the core, you need to make sure you're exploring around using different satellite positions of other active strategies, Angela.
What's the case for active investing, having someone buying and selling along the way to manage your money?
Well, I think the big case for active is this. Markets don't always move in a linear fashion. You need to pay attention to capitalization. You need to pay attention to currency. You need to pay attention to the yield curve. There's a tremendous argument across various forms of market cycles to have some level of what I call active share. Because when you over diversify, you're naturally putting portions of your money into asset classes that are going to underperform. And that's why I think active definitely shines in markets that have a wider dispersion of returns.
What about fees? You mentioned that passive investing comes at a low cost.
Well, I think at the end of the day, fees are an important construct when it comes to investing, but ultimately value's going to matter more. I mean, getting dirt cheap, low cost exposure is great unless you're cheaply exposed to risk. So the goal is not necessarily the lowest cost. It's going to be the best net outcome. That's what people need to think about with fees. I'm Craig Bolanos. If you want to learn more, you can absolutely connect with me online. Visit getretiredstayretired.com. That's getretiredstayretired.com.